Welcome. If you've ever wondered how to truly make money in stocks, you're in the right place. Many investors, including the most successful ones, started by making common mistakes, buying on the way down, holding on to losses, and focusing on the wrong metrics. But there's a proven path to success, and it's all about learning from those errors. In this video, we'll walk through the CAN SLIM system, a method developed by William J. O'Neill that has helped countless investors achieve financial independence. Whether you're new or experienced, these principles can transform your approach to the stock market. Let's dive in and start building your foundation for stock market mastery. The CAN SLIM system is at the heart of O'Neill's approach. Each letter stands for a key factor in selecting outstanding stocks: current earnings, annual earnings, new products or management, supply and demand, leader or laggard, institutional sponsorship, and market direction. These 7 fundamentals are common among the most successful stocks, especially during their growth stages. By focusing on these, you can filter out the noise and zero in on companies with real potential. Throughout this video, we'll break down each element, show you what to look for, and explain how to apply these rules in real-world investing. One of the biggest lessons is to buy stocks when they're on the way up, not when they're falling. It's tempting to look for bargains among beaten-down stocks, but history shows that the best performers are those making new highs, not new lows. Focus on higher-priced stocks near their yearly highs, and always add to your position only after the stock has risen from your purchase price. This approach keeps you aligned with the market's momentum and helps you avoid the trap of holding on to losers, hopping for a rebound that may never come. Easy to get distracted by market newsletters, analyst recommendations, or the latest hot tips, but O'Neill's research shows that these sources often lead investors astray. Instead, focus on proven factors like profit growth, price and volume action, and whether a company is a true leader in its field. Don't let opinions sway your decisions. Let the data and the CAN SLIM criteria guide you. This disciplined approach will help you stay objective and avoid costly mistakes. Charts are invaluable tools for investors. While some amateurs dismiss them as complicated, professionals rely on charts to spot trends, identify buy points, and manage risk. Learning to read charts helps you recognize when a stock is under accumulation, when it's breaking out, and when it's time to sell. Throughout this guide, we'll show you how to interpret key chart patterns and use them to improve your selection and timing. First letter in CAN SLIM stands for current quarterly earnings. Look for stocks with earnings per share up at least 18% to 20%, but ideally 40% to 100% or more compared to the same quarter last year. Accelerating earnings and sales are strong signals of a company's growth potential. Remember, even a small percentage of stocks meet these criteria, but those that do are often the market's biggest winners. Always compare earnings to the same quarter a year ago to avoid seasonal distortions. Annual earnings growth is the next key factor. The best stocks show annual earnings per share increases of at least 25% for each of the last 3 years. This consistency proves that a company's recent success isn't just a fluke. Look for a return on equity of 17% or higher, with 25% to 50% being ideal. By insisting on a strong annual growth record, you quickly weed out mediocre stocks and focus on those with real staying power. The N in CAN SLIM stands for new products, new management, or new highs off a base. It takes something new to drive a stock's price to startling heights. Whether it's a breakthrough product, a change in leadership, or a shift in industry conditions, these catalysts often precede major advances. Focus on companies that are innovating and making headlines, and buy as they emerge from sound chart bases into new price highs. Supply and demand play a crucial role in stock performance. Stocks with fewer shares outstanding are often more responsive to increased demand, especially from institutional investors. Watch for big volume spikes at key breakout points. These usually signal strong buying interest. Companies that buy back their own shares or reduce debt are also worth considering, as these actions can boost earnings per share and signal management's confidence. Always buy leaders, not laggards. The top 1 or 2 stocks in a strong industry group can deliver unbelievable growth, while others may barely move. Leaders have the best earnings, sales growth, and price strength. Use relative price strength ratings. Look for stocks rated 80 or higher, with 90 plus being ideal. Avoid sympathy plays and focus on the true innovators and market movers. Institutional sponsorship is a sign of quality. Look for stocks with several institutional owners, especially those with top performance records. An increasing number of institutional holders over recent quarters is a bullish sign. Quality matters more than quantity. 1 or 2 top-performing funds can make a big difference. Institutional buying and selling often account for most of the activity in leading stocks, driving major price moves. Understanding market direction is essential. The overall market trend determines whether you win big or lose. Learn to interpret daily price and volume charts of major indexes like the S&P 500, NASDAQ, and Dow. Look for signs of accumulation or distribution and stay in sync with the market's phase. Don't argue with the market. Let its action guide your decisions. Chart patterns are your roadmap to smart investing. Patterns like the cup with handle, saucer with handle, flat base, and double bottom reveal where institutional investors are accumulating shares. Each pattern has specific characteristics and ideal buy points. For example, a cup with handle should last 3 to 6 months, with the handle drifting down. Buying at the right point, usually just above the handle's peak, maximizes your chances of success. Not all handles are created equal. Handles that drift down in price are healthy, as they shake out weak holders and set the stage for a strong breakout. In contrast, handles that wedge upward or move sideways are more likely to fail, as they don't allow for the necessary shakeout. Always look for handles that drift down and stay above the 10-week moving average for the best odds of success. One of the most important rules is to cut all losses at 7% or 8%. If you're in a bear market, be even stricter. Cut losses at 3%. This discipline protects your capital and keeps you in the game. Don't wait and hope for a rebound. Act decisively. Over time, keeping your average loss to 5% or 6% will make a huge difference in your results. Tight price areas on weekly charts are a sign of accumulation. When a stock closes within about 1% of the prior week's close for several weeks, it's often being quietly bought by institutions. A breakout from this pattern, especially on increased volume, is a strong buy signal. Look for volume to spike 40–50% above normal when the stock breaks past its pivot point. Volume is a powerful indicator of institutional activity. Big gains on unusually heavy volume show that funds are buying shares. If a stock closes at the top of its range on high volume, buying remains strong throughout the session. Conversely, lower volume on down days suggests that institutions aren't selling aggressively. Always watch for these volume clues to confirm your buy and sell decisions. It's crucial to buy within 5% of the ideal buy point. If you buy more than 5–10% above this point, you risk getting caught in the next correction. Most correct buy points are set just below the prior peak, not at the old high. Waiting for a new high often means you're buying too late. Stick to the buy range for the best results. Proper base patterns often show a dramatic drying up of volume at the lows, followed by a surge in volume at the breakout. This pattern signals that selling pressure has diminished and buyers are stepping in. It's a constructive sign when more weeks close up on above-average volume than down while the stock is in its base. Watch for these clues to spot strong breakout candidates. Always check the relative strength (RS) line when evaluating a chart pattern. If the RS line is moving into new high territory as a stock completes its base and breaks out, it's a bullish sign. This confirms the stock is showing market-leading power and has bounced back from its correction. RS is a key tool for confirming your buy decisions. Beyond the cup with handle, there are other base patterns to recognize. A saucer with handle is similar but stretches over a longer period, making it shallower. Flat bases are tight sideways moves after a prior advance, offering a second chance to buy. Double bottoms form a W shape and signal a strong reversal. Each pattern has its own ideal buy point, so learn to spot them for more opportunities. Sometimes a strong stock breaks out but can't advance far due to a weak market. It then forms a second base right on top of the previous one, a base-on-base pattern. When the market recovers, these stocks often lead the next rally. Ascending bases are formed by 3 pullbacks, each to a higher low, and are reliable when they last at least 7 to 8 weeks. Buy as the stock emerges from these bases. Overhead supply refers to areas where previous buyers are waiting to sell as the stock returns to their entry point. These resistance zones can limit upward movement and cause frustration. Be aware of these areas on the chart, as they often lead to increased selling pressure. Understanding overhead supply helps you anticipate where a rally might stall. Most breakouts during bear markets fail. Patterns become too deep, wide, and loose, and late-stage bases are more likely to break down. Avoid buying breakouts in bear markets as the odds are stacked against you. Instead, focus on building your watch list and waiting for the next bull market to begin. Throughout history, explosive earnings have accompanied the biggest stock moves. Look for companies with major percentage increases in current quarterly earnings compared to the same quarter last year. In O'Neill's studies, 3 out of 4 top-performing stocks showed earnings increases averaging more than 70% before their major advances. Don't settle for mediocre growth. Seek out the exceptional. Strong and improving quarterly earnings should be supported by sales growth of at least 25% for the latest quarter. Accelerating sales and earnings over the last 3 quarters are especially powerful. Be cautious if earnings are rising but sales are not. This could signal trouble ahead. Always look for both metrics to be moving in the right direction. Annual earnings growth provides the foundation for a company's long-term success. Insist on at least 3 years of 25% or higher annual earnings increases. This combination of strong recent quarters and a solid multi-year record creates the highest probability of finding a true market leader. Use the EPS rating to compare companies and focus on those with ratings of 99 for the best performance. Take something new to spark a major price advance. Whether it's a revolutionary product, new management, or a shift in industry conditions, these catalysts often precede the biggest winners. Don't be afraid to buy stocks that seem expensive. What looks high to most often goes higher, while what seems cheap can go lower. Focus on strength, not perceived bargains. Volume analysis is essential for spotting institutional activity. Look for volume dry-ups during pullbacks and surges at breakouts. When a stock breaks out, volume should be at least 40–50% above normal, confirming strong buying interest. Analyze each week's price and volume to judge whether a stock is under accumulation or showing defects. When choosing stocks, always pick the leaders in their industry group. The best performers have the highest earnings growth, widest profit margins, and strongest price action. Avoid sympathy plays and focus on companies with relative price strength ratings of 80 or higher. Leaders recover faster and deliver bigger gains after corrections. Not all institutional sponsorship is equal. Look for stocks with increasing numbers of high-quality institutional owners, especially those with top performance records. A significant new position by a leading fund is more meaningful than a long-held position. Institutional buying and selling drive most major price moves, so follow the smart money. The overall market trend is your friend. Learn to interpret daily price and volume charts of the major indexes. Watch for signs of accumulation or distribution, and stay in phase with the market. Don't try to predict. Observe what the market is actually doing and adjust your strategy accordingly. Successful investing isn't about being right all the time. It's about cutting losses quickly and letting winners run. Always sell if a stock drops 7–8% below your purchase price. When you have a 20–25% gain, take profits unless the stock is exceptionally strong. This discipline ensures that your winners outweigh your losers and keeps your portfolio growing. Follow a 3–1 ratio between where you take profits and where you cut losses. For every 20–25% gain, be ready to cut losses at 7–8%. This approach means you can be wrong more often than right and still come out ahead. Over time, this risk management strategy is the foundation of long-term success. A common mistake is averaging down, buying more of a stock as it falls. This strategy rarely works and often leads to bigger losses. Instead, focus on adding to your winners as they rise and move your money from laggards to leaders. This force-feeding approach keeps your portfolio concentrated in the best performers. Think of cutting losses as buying insurance. Small losses are the only insurance you can buy on your investments. Even if a stock rebounds after you sell, you've accomplished your goal of keeping losses small and preserving capital for future opportunities. This mindset keeps you confident and ready to act decisively. Recognize climax tops when a stock has a rapid, explosive run-up after a long advance. Signs include the largest daily price increase, heaviest volume, exhaustion gaps, and rapid price run-ups over several days or weeks. Sell into this strength before the inevitable reversal. Don't wait for the top to take profits while the stock is still advancing. Be wary of new highs made on low or declining volume. This suggests that big investors have lost interest, and the stock may be ready to sell off. Other warning signs include closing at or near the day's low, third or fourth stage bases, and poor rallies after initial selling. These are signals to consider selling or avoiding new buys. Sell if a stock breaks below major support levels, such as long-term uptrend lines or moving averages, especially on heavy volume. The greatest one-day price drop after a long advance is another red flag. If a stock lives below its 10-week moving average for several weeks, it's likely in trouble. Don't hesitate to exit when support is broken. Great investors focus on correcting mistakes and building on their strengths. The biggest mistake most make is not learning from past errors. Spend time reviewing your trades, studying your mistakes, and writing new rules to avoid repeating them. This self-analysis is the key to continuous improvement and long-term success. A stock's performance is closely tied to its industry group. Studies show that 37% of a stock's movement is due to its industry, and another 12% to its sector. Focus on the top-performing industry groups and avoid the laggards. Use tools like the industry group relative strength rating to identify the best opportunities. Keep a comprehensive watch list of stocks that meet your technical and fundamental criteria. Note their buy points and average daily volume. Monitor these stocks daily and be ready to act when they approach their buy points. Preparation and patience are key to catching the next big winner. Follow these essential rules. Buy quality stocks at the right price. Insist on strong earnings and sales growth. Use charts to time your buys, cut losses quickly, and take profits at 20-25%. Focus on leaders in top industry groups and always learn from your mistakes. These guidelines are your roadmap to consistent success. Many investors miss out on great stocks due to fear, lack of knowledge, or focusing on the wrong metrics like low PE ratios. The best stocks rarely sell at low PEs and often make new highs before their big moves. Don't be afraid to buy strength and avoid the temptation to chase perceived bargains. Stick to the proven can slim criteria. Financial independence is within your reach if you commit to learning, preparation, and discipline. Don't get discouraged by setbacks. Every mistake is a lesson. With persistence and hard work, small investments can grow into substantial wealth over time. Remember, there are no overnight successes in the stock market, but with the right approach, your efforts will pay off more than you know.